I'm Sarah Borkson-Keeter with REIT.com. I'm here at REITWorld 2014 in Atlanta. I'm here with Mark Streeter, Managing Director at JP Chase. Welcome, Mark.
Thank you, Sarah.
With interest rates likely to rise in 2014, what does that mean for REITs?
Well, we're very focused on interest rates because if you look at the performance of REIT stocks, there's certainly been a lot of volatility, especially last year when we first got word of tapering and so forth. The REIT market really took a dive on that. And we saw some volatility on the credit side as well. So we're not worried about interest rates per se in terms of what it actually means for the economy, because the news is actually good. If interest rates are rising, it probably means that economic activity is improving, cash flow is improving at the property level. That's all good. But the market needs to go through a transition period. And we're in a mode right now from a REIT credit total return perspective on a relative basis where we're looking for interest rates to reset higher. That is our view at JP Morgan. Our economists have not been correct in forecasting interest rates this year, but I do think that odds favor higher rates, and I think you have to be a little bit cautious until the market adjusts to a higher rate environment in terms of how you're investing in the REIT space.
Now, the multifamily and industrial sectors seem more focused on development than others, but they have different approaches. Can you explain what you're seeing?
Sure. I mean, the multifamily development business is a pretty simple development business. The lead times are, both development businesses are pretty simple. The multifamily REITs, though, at the peak of the prior cycle, they were really investing about 20% of their balance sheet on development. Now they've cut that back more to the 10 to 15% range, and we're very comfortable with those development pipelines. So really what they've changed is just the magnitude of the development, not necessarily how they've gone about it. The industrial REITs, however, though, have gotten away from merchant building. I mean, Prologis at one point, old Prologis had an $8 billion pipeline and so forth. Now it's much more measured, and they're doing much less merchant building. And these development pipelines on the industrial side have become less risky. They've inherently changed in terms of the approach from management. So I think you've seen a downsizing of multifamily development, but you've seen an actual shift in the way the industrial REITs manage their development pipeline, which from a credit perspective is more positive.
Now, we've seen a number of REITs seeking to improve their credit rating and access the debt markets. Do you expect that to continue into 2015?
We do. We've seen several new names come to the market now. We're close to 60 REITs that we have under coverage from a credit perspective, and the sector right now is approaching $150 billion of bonds issued. Clearly, I think most large or REITs with a desire to be large players in the public market realize that having access to a rating and the public capital markets is a good thing. There's still a few holdouts. A name like General Growth is a holdout from that perspective in that they don't really utilize unsecured bonds in their capital stack. But across the board, look at all the new names that have come to market this year. CBL is one example of that. We've had several other new names, WP Carey, to name another. So we expect several more REITs to seek credit ratings, come to the market. That pipeline is not deplenished at this point, and I think shareholders are continuing to call for that. I think they want to see REITs have access to all forms of capital because that ultimately is what's most efficient, and that in turn has an impact on equity multiple as well.
Well, thank you very much, Mark.
My pleasure.
And for more news and analysis on all things REIT, please visit REIT.com.